Mark, get set, go.
Hello, this is Ron Fossum. We met through a marketing group in 2017. I've been using his tax services ever since. Saved me tons and tons of money, and I just wanted to go over, let him explain what he does and kind of how he could help just about any business there is. So, Ron, thanks for doing this.
Oh, appreciate it, Nate. Absolutely. Looking forward to it.
So, how can any business owner clients or my business owner clients pay less in taxes?
Well, it's really tax and accounting kind of gets lumped together as if it's the same thing, but they're really two totally separate niches. Uh, Let me think. Are you seeing the screen?
Mm-hmm.
The tax and accounting team? Okay. So it usually goes like this: from the level of sophistication and expense, starts with a bookkeeper that does all the day-to-day transactions, and then an accountant, then a CPA, or EA is a IRS enrolled agent, very similar to a CPA. And unless you ask a CPA, they'll tell you they're very different. But there's only a couple things a CPA can do that an EA can't do. And then all of that is trying to get you to prepare your taxes, which is what we all have to do. And what we've noticed is the level of sophistication. Clearly, a 4-year degree is someone more sophisticated about understanding the numbers in your business than just a bookkeeper. But everyone above this line tends to be very reactive and very tactical about how they go about your business. So it's usually at the end of the month, end of the year, end of the quarter. They look at the business activities that we've done and then just recorded that activity and then file that form. What you start to see below the line is fast growing companies, super profitable companies have controllers, which is all about controlling costs, tax resolution if you're behind multiple years, tax planner, which is kind of where I spend most of my time, and CFO, Chief Financial Officer. Chief Financial Officer and Controller are very similar, except a controller is all about reducing expenses. CFO is reducing expenses, but then also how do you grow the company? And then tax attorney. So we have everybody on our team in all of these spots, but where I spend most of my time is this tax planner, CFO world. And we tend to be more proactive and very, very strategic about how we can look forward and put the business owner in the best place to align this activity and this one, and stack up those activities so that by the end of the year, everything is in the books correctly, and then consequently they pay less tax, as opposed to waiting to the end of the year.
So you kind of answered my second question. What if they already do end of the year tax planning?
Yeah, that's kind of a oxymoron. It's common in the business, but it's like the end of the year is already over. So there's not that much to do if you're doing it at the end of the year. It's more of a final end of the year projection of what your tax bill is going to be, but it's certainly not tax planning. That is, how can I reduce this bill in a very strategic manner, for sure.
So how does your tax planning team approach tax planning?
It gets back to this tactical versus strategic thing I mentioned a little bit earlier. Is when something is tactical, it's very methodical, step-by-step process, which is exactly how bookkeepers, accountants, and CPAs are all taught, and even tax preparers. They're all taught to be very step-by-step oriented in their whole process. There's literally, and bless their hearts, the CPAs have a tough job. Like you remember the old Yellow Pages books, right? And if you were in a big city, it'd be 3-4 inches thick. And the CPA exam, they have 4 of those to be able to identify all these different types of business activities and make sure it gets on the right form, the right time, and gets filed. So they got a tough job. It's one of the hardest exams out there, hands down. But there's not a single question or a single strategy in there that teaches them how to reduce tax. It's all about identifying the activity and putting it in the right form. There's literally nothing in the whole process in any of those jobs above that line that talks about how can I reduce the tax? What strategy should this business owner employ that will actually move the needle in a big way? So that's where we spend most of our time between the tax planning CFO and the tax attorney. We're very proactive around that, and we're more 30,000 foot view. Let's strategically think through, if they're doing this activity and this activity, if we just add this one more thing, document it this way, that's going to reduce their taxes by 15,300 or whatever the number is.
So can you give me some examples of tax planning in action?
Probably one super common one that is super common as far as what people have heard. I've seen it implemented very rarely. But everyone knows in 2017, Trump passed his tax plan, so it got implemented in 18. When that happened, employing your children used to be like a $6,000 deduction, but that doubled. And so now the standard deduction is $12,000 per child. So as a business owner, if you've got 3 kids, you can employ your child for $12,000 each. There's $36,000 if your kids are of working age. That's $36,000 that you can deduct out of the business, pay no Social Security, FICA, or any taxes on that. Comes out of the business tax free, and it goes over to them. And at $12,000, they don't even have to file a return. So it's tax free money into your household. So now the kids can start buying, their own school supplies, their own after school activities, because that stuff's not deductible. So that's a big one. It's just employing your children that I think a lot of people have heard about, but they don't implement nearly as much. And that one moves the needle big time. There's a secondary one on top of that where you can go from $12,000 to $18,000 per child. So what's 18 times 3 is $54,000. You can pull 3 kids, you can pull $54,000 out in a tax-free manner. Another one that is maybe not, let me show you this one. It's not as common. This is publication 527, and it's directly from the IRS code. And I won't bore you with the whole thing, but it's really talking about when is this a residential property, when is it a rental, when is it a vacation home, and that kind of thing. If we bounce down, there's 2 things here, is what type of properties qualify for this special rule, and what's the tax break because of it. So when we're thinking about our entity structure, if we have an LLC or an S Corp, we're supposed to be having meeting minutes, resolutions, amendments, those kinds of things to really separate our personal and business liability. The last thing we want to do, we set up the entity. The last thing we want to do is have that business activity attract a lawsuit, and they're able to pierce that corporate veil and come over and attach our personal assets. And so it's really important that you have those. And so most attorneys will tell you asset protections, you got to maintain that entity, not just set it up once and you're done. So if it's a law that you have to have these meetings and maintain this entity, document stuff, even if you're a 1-person member LLC or something, it sounds silly, but you got to have these meetings with yourself. Document those meetings. If it's a law that you document these meetings, then where can you have these meetings? So this is where this one comes in. It says that there's a special rule if you use your dwelling unit as a home and you rented it less than 15 days during the year. Dwelling unit can be a house, an apartment, condominium, mobile home, boat, vacation home. So it can be any of those things so long as we have a sleeping space, toilet, and cooking facilities. So long as we've got those 3 things, the property is going to qualify. Ownership doesn't matter because it can be an apartment, right? That's one of the types of properties that qualify. So you don't have to own it. You can be a renter and do this in your apartment. So those are all the properties that qualify. The tax break shows up down here. So that can't be a rental, right? If you've rented your house out for 365 days a year, that's clearly more than the 15 days. So it doesn't work for rentals, but any of your primary residences you can. And I used to just tell people this and they never believe me. So that's why I show it out of the code now, because it makes a difference. So if you use your dwelling unit as a home and you rent it less than 15 days, its primary function is not considered to be a rental. It should not be reported on Schedule E Schedule E is where we do all real estate on your 1040 form. Not be reported on your Schedule E. You are not required to report the income or the expense from this activity. Like, people don't believe me when I say the code actually says you don't have to report income in certain situations, and this is one of them. So if it's a law that you have to have these meetings, have the meeting in your house, maybe once a month, maybe 12 a year. You can go up to 14. And so the business rents from you personally. Your business has an EIN number. Your business can rent from you personally with you as your social security number. It's just like the kids. It's deductible to the business and completely tax-free to you personally. So there's all kinds of documentation you got to do, several different documents, but it's super simple. Do it yourself. It doesn't cost you hardly anything to implement, to figure out what that number was. But just as an example, I'll give you two extremes. Let me pull up a calculator real quick. The lowest I ever did was kind of a starter home in Montana, and it was about $800 a day times 14 days. I think the guy's house was like 1,200 square feet or something like that. And so this person was able to pull out $11,200 out of the business and completely tax-free to himself. So that's in the middle of Montana. So kind of hard to get comps and what's reasonable in Montana. Got another client in downtown Manhattan who had about a 42 or 4,300 square foot house in Manhattan. And if you guys have ever spent time in New York, you know, all the hotels are like union run. So it's ridiculously expensive. So when we called around for quotes on his house and what's comparable in Manhattan, it was $15,400 a day times 14 days. Now, mind you, this is the exact same strategy, but this gentleman, what's reasonable for him is $215,000. Same strategy, 11,000 and 215 based on the size of the house and where you're located. Makes a big difference. So there's a couple examples of how a tax planner will look at your situation and go, if you're already going to have these meetings, why not figure out how much it's going to cost in your local area, and then rent your house out. And this is completely separate than the home office. So the home office is only a percentage of your entire house. This is renting your entire house out to your business for that day. That make sense?
Genius.
Yeah.
Does someone who wants your team to help them have to change CPAs?
No, they don't. And actually, probably more often than not, we encourage people to keep whoever they have on that, back to that tax team that we had earlier. Whoever you've got in team, it's kind of the Warren Buffett approach. If you've ever looked anything Warren Buffett does, he wants everyone to stay. And he usually has them sign like employment agreements before he invests heavily in that company. So we kind of like it. If you've already got a bookkeeper, accountant, CPA, tax preparer, keep all those guys, and we'll help implement and guide them to make sure everything gets documented, because that's the super secret sauce, is document. That's how you're going to be able to keep these strategies. Most of the time the IRS gets stuff kicked out, it's because the taxpayer didn't keep the documentation correctly. So keep your tax planner, keep your tax preparer, your CPA. We'll implement stuff throughout the year, make sure it gets in the books correctly, and then a good tax return, a quality tax return with paying the legal minimum amount, legally, morally, and ethically, is going to be a byproduct of already having all of that in your QuickBooks.
Can you give the tax statistics of Warren Buffett, since you brought him up?
So yeah, we don't see everyone's tax returns every year. They're supposed to be private, but for some reason 2010 is out there. So in 2010, he earned $39 million a year, and yet he paid a 17% tax. And let me show you this one. So this is 2020. Anyone who wants this, like, they can just ask. Callen asked me for it. This is all the different tax brackets for 2020. It's also got, all the retirement contribution amounts, mileage amounts, like all kinds of capital gains amounts. Just a one sheet for all kinds of stuff tax related. But look at this. Most middle Americans are probably in this 150, 80 to 150 range would make a lot of sense. That's $9,000 plus 22%, right? So that's probably like a 26, 27% bracket. The highest bracket, $600,000, they're paying $167,000 plus 37% plus the state tax, right? If you're in California, that's another 13.9% on top of that. So this is probably a 45, 47% number plus state tax will put you over 50%. And Warren Buffett earned 39 million and paid 17. So clearly there's such strategies that the wealthy use and most small business owners don't know. And that's all we're doing is what are these big guys doing?
What's the process for understanding kind of everything you offer and your pricing?
Yeah, simply all we have to do is set up an appointment, and we'll go through your situation, and you can explain what you're doing, what's working, what's not working. We can look at your tax returns if you want. We've got some pre-built, already packaged tax plans, anywhere from like a brand new company and startup all the way through super high-end comprehensive strategies. Or we can write a custom strategy that every single strategy in there is going to be perfect for you. And we can also, because of that, it's a custom written strategy, we can guarantee a certain amount of savings that you're going to be able to see out of those plans. So it's very clear that, in fact, let me show you a sample. Well, here's a snapshot of some different industries we've been able to help. And this is just their first year tax savings. This is how much people were overpaying in their first year. Like this diesel shop, good friend of mine, and he was like, man, I could have completely funded my entire retirement that way because I've been overpaying. I had the same CPA for 20 years. He was one of the guys up front that says, hey, I want to keep my CPA. Once he saw this number, he was like, I want to replace my CPA. So we kind of had to talk him through that one. But yeah, the Forbes says that 93% of people overpay their taxes by 10 grand or more. 93%. So it's practically everybody, for sure. But we do it on a very simple basis. We give a tax savings promise up front, so it's a real simple. If we can't get to this number, then we just refund your money, for sure. And we don't just stop once we fit that number either. In this case, we went to $33,717 in the strategy. So it's a super simple process. A little bit further down, if I bounce down here, let me find one. So that's how you know you're at the, so there's the Augusta. It's a very simple process. We've got 8 steps to implement it. And here's all the IRS code and the Treasury code, the revenue rulings, IRS revenue procedures, relevant court cases, any kind of landmines and that kind of stuff is in here. So, and that's another reason you don't have to replace your CPA is we've given you everything you need. It could be a standalone, and some clients just take it and go implement it. Some clients want to make sure that stuff gets done right, and so they engage us separately to make sure that it gets implemented and someone's kind of overseeing the documentation process. And we can help either way. But it's very simple, easy to read. There's no acronyms. There's no jargon, industry jargon. If a high school reading level couldn't read it, then we had to rewrite it. So we took all the legalese out of it. It's super simple to implement, for sure.
And then I guess how can they follow up with you? Because they should want to.
I get kind of excited about this stuff because it makes a big deal. Like the question immediately becomes, what would you do with the funds? Would you properly fund your own retirement, or would you hire that person that you've been wanting to hire to actually grow your business? Would you spend more on marketing? Most of my clients, we almost always spend like 25, 30% more on marketing, which is where you guys really come in, because you guys got that handled down pat. But there's so many different things that a business owner could do to grow their business, make it more safe, make it more secure, remove some risk out of it, and bring more home to the table personally. Then I think it's a no-brainer. So down below, we'll have a calendar link. You also have a phone number. You can just call my staff, get on our calendar. We'll go through your stuff. We'll have a meeting just like this, and see if there's some way we can help you. You can ask all your personal questions. We do everything not through email, so it's all private and secure. We have a secure portal that all the information is shared that way. And when we deliver the tax plan, we actually deliver it this way as well. So I go through the tax plan step by step. I explain every single strategy. You can ask questions on every single strategy, just to make sure you fully understand it. And then we also include a couple hours of consultation, because just because I give you 10 or 15 strategies, you're not going to go do 15 strategies next month. So inevitably, people call me a month later, 2 months later, and that's all included in your original tax plan price, because everyone's going to have questions. No one lives and breathes this stuff, but us tax geeks. But and we know that. So that's what the process is like. You just grab the calendar link, schedule yourself an appointment, and we'll go from there.
Cool. Well, I appreciate the time, Ron, and hopefully some people will hit that link.
All right, buddy. Thanks for the call. I appreciate it.
Thanks.
Bye-bye.